The perfect investment is not perfect if you have to overpay by 30%. If you have to believe that trees grow to the sky.
Hey everyone, welcome to another episode of The Remote Investor. I'm Michael Albaum, and today with me I have an old friend and a very special guest, multifamily syndicator, operator, aficionado, Paul Moore. Today we're going to be talking to Paul about what things we need to be aware of when it comes to multifamily investing and what the heck is going on in the space. So let's get into it. Mr. Paul Moore, thank you so much for coming on and hanging out with me today. I really appreciate it, man.
Michael, this is great to be here. How have you been?
It's been a whirlwind of a ride since we last saw each other. I've since had a kid. I've moved, done all kinds of sorts of investing. What about you?
We're having the time of our life here. We're wrapping up our Wellings Real Estate Income Fund. We're getting ready to launch a growth fund and a separate income fund with just a bunch of different syndicated real estate, self-storage, mobile home parks, RV parks, etc. And I think it's, Warren Buffett, this is crazy. And I just got to say this, Warren Buffett, if you took Berkshire Hathaway's stock price, cut it by 99%, like if it was $100, you cut it to $1, it would still wallop the S&P 500 over the last 6 decades. Okay. So we ought to listen to these guys. I know, look it up. It's crazy. You can go check it. There's an article in Forbes about it. But here's the thing. Buffett and Munger's claim they never had one conversation about the economy when they made an investment or a divestment. So in other words, they never said, well, what's going on with interest rates? What's going on with tariffs? What's going on with this or that? They were looking for durable products in recession-resistant asset classes run by great managers. And so I'm not saying we're Berkshire or Buffett, but we're trying to do the same thing. So we're making the same purchases and the same investments we were 5 years ago when everything was booming. We're still doing the same things. We're still getting really good results. And one of the ways we're doing that is by finding deals with intrinsic value built in. And I could get into what that's about. But anyway, that's where we're at as a company.
Oh man, I love that. And I am very excited to hear a little bit more about it if we have time on today's episode. But what I would really love to pick your brain about, Paul, is what the heck is going on with multifamily? It just I know you're a huge multifamily guy. I would love to just let's get into it. Let's hear the good, the bad, the ugly. What are your thoughts? What is going on in the space?
So I wrote a book called The Perfect Investment. I know it's a humble title. And in 2016 about multifamily. And then I went on Bigger Pockets I had a show there on not YouTube, Facebook Live and Instagram Live. And I wrote blog after blog after blog saying, time out. The perfect investment is not perfect if you have to overpay by 30%. If you have to believe that trees grow to the sky. In other words, rents will go up by 10% forever in Tucson.
Right.
If you have to believe that your inflation is going to drive rents up, but your operating expenses down. If you have to believe that your 10% vacancy is going to go to 1% vacant. If all that has to go right, and then you slap risky floating rate debt on it on top of that and believe that his 5,000-year low interest rates are going to stay with us forever. If all that has to go right for your deal to go right, you haven't got a perfect investment. And Mike, I don't claim to be a prophet or anything. It was obvious from reading Buffett, Munger, Howard Marks, these other people in the equities world that we were in a bubble, and we were. And of course, March or April of 2022, the cracks started to show. Now, the 11 interest rate hikes didn't cause a problem. They only showed the problem was already underneath, that was already brewing underneath. For 10 or 12 years, everything went up because a rising tide lifts all boats. But like Buffett said, someday that tide will go out and then we'll see who's skinny dipping. And that's exactly what happened. The interest rate rises really, really exposed a lot of syndicators and deals who made a whole lot of mistakes. And so we have been in a 3-year cycle where, a lot of the shiny objects, a lot of the shiny object chasers have lost a lot of money. And, here's the crazy thing. Back in those years, the more you leveraged, the better your outcomes were. I mean,
Right.
if you had
Right.
the same deal at 50% leverage and somebody else had that same deal at 80% leverage, same income, same cap rate, well, the one with the 80% leverage is going to give their investors more than double the profits when they flip it in a year and a half or two, as the guy at 50%. But when the market turns, when interest rates go up and that floating rate debt overtakes you, the people at the 80% debt are going to be consumed over twice as fast, and it's actually worse than that. But at any rate, that's what happened over the last couple years. Now, we had this overbuilding boom in multifamily. I believe it was 5 or 600,000 units a year being built, and of course, with interest rate rises, the overbuilding in the Sun Belt and other things, multifamily starts have ground, I won't say to a halt, but they've ground down
Come way
to,
down.
about a half or a third of what they had been, which is creating an incredible moment in time. I'll take a breath.
No, this is super good, Paul. I just like follow up question. The people that got this floating rate debt, the syndicators that are just losing their shirt now, were they new? Were they too green? Did they just get lazy? Did they get greedy? Like, why were these seasoned operators potentially taking floating rate debt, knowing that there was a markets have cycles?
Some of them were seasoned. My mentor, who was against that, actually succumbed to it in 2020 or 22. They started doing floating rate debt. Here's Let me back up. In 2012, there was the Jobs Act, and Obama passed this, under Obama, they passed this act that allowed syndication to flow freely. You also had social media, which had, hit an unprecedented, between Twitter and LinkedIn and, Google AdWords, Facebook ads, all these different platforms. You've got guys, and I want to be super clear here. There's nothing wrong with being in junior high school in the great financial crisis. Don't hear me wrong. That's my business partner was. But when you're in the in 2008, if you were in junior high school, you'd never seen a recession. If you didn't have somebody coaching you and telling you stop, it's likely that you kind of believe that lie that trees are going to grow to the sky this time. You've got Grant Cardone out there, literally, I'm quoting him from the stage saying, just buy multifamily, just get in. It doesn't matter what you pay. People always need a place to live. It's not quite a quote, but it's almost a quote of what he said. And so people believe that. So thousands of people. Oh, you've also got the rise of mentoring programs by gurus. And some of these gurus hadn't even done that many deals themselves. But again, all these factors went together. You've got millions of people, doctors, lawyers, dentists, high income professionals, IPO people, all these people who had never even heard of investing in a syndication now jumping in. And think about it. Every deal looks good on paper. Every website looks beautiful. Every deal looks like it's going to be a winner. And when these people with the 80% leverage and everything, they kept succeeding, all their friends at work or whatever would jump in. Well, here's what happened. You got places like Dallas and Houston where there was these really big time mentors. I mean, they were on the radio telling people, come make a fortune in multifamily, $20,000 to get in. And these guys were getting out of there and bidding against each other. And this finally gets to your question, Mike. They were bidding against each other, and they were bidding the price of a $10 million apartment building up to $13 million, 30% over what it should have been. Like I said 5 minutes ago, everything had to go right to make that deal go right. Well, one of the things they had to do to be able to afford that is have no prepayment penalty so they could flip it quickly. And they had to have the lowest interest rate possible. Well, that came with risky floating rate debt. And that's why they got it, because the only way they could afford to do any deals was to do that deal. And think about it. They had a big following on social media, thousands of potential investors waiting to write them a check. They had, right, to do a deal, or they would not be making any money. They were making money off fees on the front end in some cases, not always. And so to do any deal at all, they had to use risky floating rate debt. That's what they did, and it all crumbled down.
Dang. Dang. Well, that's a bummer, obviously, for so many people, both investors and syndicators. So, what are you seeing now as the opportunity? Because behind every tragedy or rough patch in time usually comes opportunity. So, where do you see things kind of going from here?
Howard Marks says the seeds of failure are planted in the moments of greatest success. And of course, the seeds of success are planted in the moments of greatest failure. So we've had some failures. And, you might think I'm going to talk about the fact that there's all these deals going to hit the market, foreclosures. And I'm not even going to get into that. That there may be a lot of that this year. There's 384 billion, I think, in commercial extend and pretend deals that are going to come due soon. By the way,
Mm-hmm.
banks are going to be way more likely to foreclose this year because, of course, notwithstanding the latest news here as we record this with the tariffs and
With the tariffs.
all the stock market, being down, but they're going to be way more likely to foreclose as there's optimism in the multifamily market, and as they think that there's going to be somebody there to scoop it up, and maybe they can be made whole on their loan. That $13 million deal I used as an example might have had, let's say, $9.5 million debt on it. If they think they can get somebody to take it off their hands for 9.5 or 10, they might do it where they might not have a year ago. That's not what I want to talk about, though. What I want to talk about is a Business Insider article in February was titled, America is About to Enter an Apartment Crunch. In fact, a Wall Street Journal article the same week said we're headed toward a landlord-friendly era. Expect higher rents. And that's the two article titles. So what's driving this? These articles said construction has slowed dramatically. Costs were up. Developers backed off. Number two, new supply was shrinking just as demand is really rising because there's tremendous increase in demand. There's millions of units shortfall in what there needs to be now, and it's probably going to be worse by 2035, depending on how things play out. Number three, home ownership is so unaffordable for millions of people. What this has all resulted in is landlords are gaining pricing power again. In fact, it looks eerily similar to 2012, 2013, 2014, but this has also created maybe a false sense of security like it did then. And I'm here to say, if you're an investor or if you're a syndicator, don't fall prey to the same mistakes people made last time. And I've already went over those mistakes in a lot of detail, and we can talk about, maybe how investors and syndicators can avoid those next time.
That's, you took the words right out of my mouth. So if somebody is kind of just getting started in the multifamily space, maybe they own a 2 to 4 unit building, maybe they've got a couple single families and are thinking about getting into the small commercial multifamily, so 5 units plus. I
Yeah.
mean, is this, are those type of assets going to be impacted by what you see coming down the road, or is this only for those massive 100 unit plus syndicated deals?
I think it's all going to be affected. I mean, when it's, and I'm making up a number here, I don't have it right in front of me, but let's say it's an average of 3,000 or 3,500 a month to own a home, and the average rent for a similar location is 2,500. Well, rents, I mean, sure, home ownership prices might come down a little when interest rates drop, but that $1,000 or so difference is going to eventually drive rents up, especially when there continues to be the shortfall of units. So, what can syndicators and investors do to avoid the problems of last time? Well, obviously, one, avoid over leveraged deals. I mean, if you're an investor and you're looking at a deal with floating rate debt with no caps, run away. Just don't do it. Just say
Yeah,
no.
yeah,
Buffett reminds us that unlike baseball, you can stand there and you could take 1,000 pitches, and all of them could be strikes, but you won't get any strikes called if you're an investor. If you just don't do it, if you just stay on the sidelines, it's okay. I mean, you may not make as much money as if you invested perfectly, but it's okay to say no. Look, Buffett's got 350 billion or so in cash, in T-bills.
But
He's not
Paul,
dumb.
if you don't get off the sidelines and invest today, you're going to miss out. You got to invest today. You don't want
Yeah.
to be the guy missing
Yeah.
out.
Yeah, I know. I know. That's exact. And see, that brings me back to one of my problems. So when I started investing, and I talked about this on your other show perhaps before, I thought the default to every investment opportunity should be yes, and it had to prove itself as a no, or I was in. Of course, I ran out of money quickly thinking
Yeah.
that way, because
Yeah.
every deal looks good, especially if
Right. They
you
all
don't know how
work.
to do due diligence, and I didn't. And especially if you're a speculator, which I was.
Yeah.
Don't do that. Buffett said the best investors say no. The very best investors say no almost every time. And so that's what we need to do, is say no almost every time. So avoid over leveraged deals. Avoid risky floating rate debt. Focused on fundamentals, not projections. Is the deal priced based on current cash flow or some fantasy of future rents? Does it have
Mm.
real value add potential, or are you just paying a premium for hope, smoking hopium, as some people call it? Um, are the underwriting assumptions conservative, or are they aggressive? Um, another thing I
Let me
would,
just pause you there, Paul,
yeah,
real quick, real quick. To that point, so I've seen so many offering memorandums, both for syndications, but also for multifamily deals that I've either put bid on or purchased or passed on, and these are put together by the selling agent or the selling brokerage. So, and they'll often do actual, and then they'll do a pro forma. So how do I, as a newer investor, understand and know and identify some of these overhyped assumptions? How am I to know if what they're telling me is pie in the sky or is truly possible?
it's really hard to answer that. Here, I mean, we have a team of 3 people analyzing these deals to death and saying no to almost every deal, that all look good up front, by the way. I mean, one quick answer to your question would be, and I think Brian Burke.
Mm-hmm.
Um, get Brian Burke's grueling 350-page book called The Hands-Off Investor. He talks in great detail, how to answer those questions. A lot more than we could cover here. But
Okay.
yeah, I mean, try to look and just put yourselves in the mindset of saying no, with a default of saying no, and make the deal prove to you it really can do this. Have they tested it at this higher rent? Have they tested what it would be like to add granite countertops and paint and flooring? Are they proving there's a waiting list at that higher price? If
Yeah.
not, take it with a grain of salt and say, okay, what's worst case here? What
Right.
happens if rents go down? What happens if vacancy goes up? What happens if insurance goes up? Test all those things.
What happens? I mean, when insurance goes up,
Yeah, right. I know.
it's funny you mention all these things. Like it always cracked me up when I see these OMs of agents saying, "Oh, well, these are the current rent's $1,000, but market rent's 1,500. So you could just slap somebody in there." I was like,
Yeah.
"Great, why don't you do it?
Yeah.
Why don't you go do it and then sell me the property and I'll pay more for it?" Like, oh well, I'm like, yeah, I didn't
Yeah,
think
right.
so.
Yeah, exactly. I love that. That's very well said. So, I mean, again, and here's another thing: vet the operator more than the deal.
For the syndication side of things, yeah.
Yeah, I mean, how did they handle deals in 2008? Oh, they were in elementary school in 2008. Okay. How did they handle deals during the 2021, 22, 23, 24 rate hikes? Did they have experience in down markets or just boom cycles? Find out about their worst deal. What did they learn from it, and how they implemented that? Why? There's a book called "It's Different This Time," which is of the fallacy of thinking it's different this time.
Yeah.
And prove to me that that you're really set up for success this time, because you failed last time, or maybe you weren't even in the business last time. You were selling car insurance or selling cars at a used car lot. Why Should we send you $100,000 now? And again, they may be fine. Everybody started somewhere. I wasn't doing this 20 years ago, but make them prove that they really are competent and that they care more about your money than their own. Look at their fees. How much are they making if this fails? Wellings Capital just had a deal that was essentially a failure. I mean, we didn't lose investor money. We made money, but it was essentially a failure. And the syndicator took a fee at closing that they never should have taken. And they said, well, it's right here in the documents. It's right in the PPM. And I'm like, how can you in good conscience take this fee when you failed? And they're like, well, it says it right here. And it's like, no, think about all that.
Yeah. And then what about like on the personal side? So if somebody wants to go get into a 5, 6, 7 unit property, it sounds like there might be some opportunity coming up down the road in your estimation. Is that right?
Yeah, there is such a huge number of larger multifamily that have already had the value add done. They've already had the granite countertops from China added. I'm not making fun of the granite countertops from China. I'm glad that they're cheap. I've got them myself. Everybody's got them now.
Yeah.
Think about it. When we were kids, nobody had granite. Nobody heard of that, at least when I was a kid. So they've already got all the heavy lifting done. And there's also a whole bunch of duplexes and fourplexes that have had the heavy lifting done. But right in that sweet spot, 5 to 70 units, 5 to 10, 20, there's a lot of mom and pop still. And there is still opportunity there, at least in my opinion. And I think if somebody only had a nationwide like MLS to see what prices should be, man, they could really do well if somebody had something like that.
I know we should figure out how to do that, shouldn't we?
Right?
Oh, you're so kind, Paul. So it's funny because that's where I cut my teeth, in that 5 to 15 unit multifamily space. And at the time when I was buying them, this was like 2017, 18, 19. I was buying them for a song because they were beat up and nobody wanted them. And I was looking around proverbially. I'm like, okay, I'm the only person bidding on this. Like, what does everybody else know that I don't? When's the other shoe going to drop? And what I realized at the time, at least in my opinion, was that it was too big for the mom and pop investors and too small for the big institutions. It's not sexy. And so people are like, forget about it. It's too much work. And I'm like, yeah, it's boring. And I'm like, I'll do it. I think it's sexy. It's more sexy than what I was doing with single family and 2 to 4 units. It was exciting for me.
Right.
And now it seems like that's what a lot of people are looking to get into.
Right. It's absolutely true. This is a time for that. Unless you want to go to a different asset type like self-storage, mobile home parks, light industrial outdoor storage, something where there is a lot more runway. I would probably be thinking about avoiding a lot of the multifamily out there.
Yeah. Makes total sense.
Yeah.
Makes total sense. And Paul, real quick, one more question before we let you out of here. You said multiple times to avoid over leverage. What does that mean? Can we define that? Or is it so deal specific that it's tough to put a number on or put a point on?
It's certainly deal specific, but do some stress testing and see what happens, if hopefully, you're not using floating rate debt, but if you are, do you have a cap on? Well, those caps expire, as everybody found out. Those $50,000 rate caps cost $200,000 in 2023 to renew, or no, more like $2 million from what my friends told me. We didn't have any floating rate debt, but yeah, literally, I had friends telling me that they cost $50,000 to $100,000 when that rate was up here and their rate was here. But now when their rates blew through that, to get back there was like $2 million or something. And they had to raise preferred equity, rescue capital, inject their own money. Doubt it. They do capital calls to get the money to keep them out of trouble. And a lot of people are losing their deals. I was shocked. I don't know if it was Biz Insider or one of those, online type business journals. They had an article in November. You can find it, November of 2022. I don't remember the name of it. It was like today's multifamily kings or something. And it had these two guys who were about 32 years old, and they were the Tides Equities guys who came out of nowhere and had a $6 or $7 billion portfolio at age 32. Do the math, 32, that puts them in junior high school during 2008 or maybe high school. And again, nothing wrong with that. But they had all this risky floating rate debt. And literally just 3 months later in that same publication, they said, Tides is in trouble. And of course, now we know that they've lost billions of their deals and who knows how many hundreds of millions of investor money.
Wow. Okay. Well, on that note, we'll end it on a high note. But Paul, where can people reach out to find you? Reach out any additional questions? Reach out to find more about Wellings Capital.
Yeah, they can go to Wellings Capital. That's WELLINGS, wellingscapital.com. And if they want to get some free stuff on self-storage, mobile home parks, RV parks, or just, I think better yet for your audience, an audio or written version of the introductory course to investing in commercial real estate, it's wellingscapital.com/resources.
Awesome. Well, thanks so much, Paul. This was a lot of fun. Definitely look forward to chatting again soon.
Yeah, it'll be great. Thanks, Michael. Take care.
You too. All right, everyone. That was our episode. A big thank you to Paul for coming on. Lots of really great insights and definitely an interesting time if you are thinking about getting into multifamily investing. As always, we love hearing from you. Ratings and reviews are super helpful wherever it is you get your podcast. And we look forward to seeing you in the next one. Happy investing.